Hey, James here. And if you checked the silver market this morning and felt like something was off, congratulations, your instincts are working because what you are witnessing is not random volatility, not normal price discovery, and not just another speculative wave. You are watching the early stages of what could become one of the largest precious metals squeezes in modern financial history. And this is not built on conspiracy theories or emotional hype, but on publicly available data that anyone can verify by simply looking at the COMEX reports, the inventory breakdowns, and the open interest statistics that are updated daily. Because right now, the COMEX exchange, which acts as the backbone of global precious metals pricing, is sitting on roughly a little over 100 million ounces of registered silver available for delivery, while the total open interest in futures contracts represents more than 400 million ounces of promised silver. Meaning that for every single ounce of real, deliverable metal sitting in those vaults, there are more than 4 ounces of paper claims floating through the financial system. And if you pause for a second and truly understand what that implies, you begin to see the structural fragility embedded inside the pricing mechanism itself. Because futures markets function smoothly only when the majority of participants roll contracts or settle in cash rather than standing for physical delivery. But the moment a meaningful percentage of contract holders decide that they actually want the metal instead of a paper settlement, the leverage becomes exposed. And that is exactly what appears to be happening, as delivery demands have surged far beyond historical norms, with a single month seeing physical delivery requests that dwarf the average 5 to 10 million ounces typically seen in calmer conditions. And when 40 million ounces stand for delivery in such a short window, it signals that large players are choosing possession over promises. And when possession becomes preferable to paper, it usually reflects declining confidence in the financial architecture that underpins those paper claims. And this shift is unfolding against a macroeconomic backdrop that further amplifies the tension, because silver is not rising in isolation, but in conjunction with falling bond yields, softening economic data, and growing market expectations that the Federal Reserve will eventually be forced to cut rates, despite public statements suggesting patience and stability. And historically, whenever real yields compress and monetary policy pivots from tightening toward easing, non-yielding hard assets like gold and silver tend to outperform, because the opportunity cost of holding them declines, while the currency in which they are denominated expands in supply. And when you layer that monetary dynamic on top of the structural supply-demand imbalance in the physical silver market, you get a setup that begins to resemble prior historical episodes of extreme repricing, most notably the late 1970s, when silver moved from single digits to $50 per ounce in less than a year, during a period defined by inflation fears, currency debasement, and aggressive accumulation by large investors who recognized the disconnect between paper pricing and physical availability. But unlike that era, today's market is exponentially larger, more interconnected, and far more leveraged, meaning that if confidence in the paper mechanism erodes, the reaction could be faster and more violent, because modern markets transmit stress instantly across global trading desks, hedge funds, sovereign wealth funds, and retail platforms. And the psychology component cannot be overstated, because markets are ultimately driven not only by arithmetic, but by belief. And once enough participants question whether paper contracts are fully backed by deliverable supply, the scramble to secure real metal can intensify rapidly, creating a feedback loop where rising prices attract more attention, which attracts more buyers, which tightens supply further. And this dynamic is compounded by silver's dual identity as both a monetary metal and an industrial necessity, since unlike gold, which is largely stored and rarely consumed, silver is embedded in solar panels, electric vehicles, electronics, 5G infrastructure, medical applications, and defense technologies, meaning a significant portion of annual production is irreversibly used in manufacturing processes and eventually discarded in ways that make large-scale recycling inefficient or uneconomical. And because most silver is mined as a byproduct of other base metals, such as copper and zinc, its supply cannot simply be ramped up overnight in response to higher prices, as new mining projects require years of permitting, financing, exploration, and development before meaningful output reaches the market. So when investment demand collides with constrained industrial supply, the imbalance places upward pressure on price as the only mechanism capable of rationing limited availability. And at the same time, central banks around the world have been accumulating gold at record levels in recent years, as geopolitical tensions rise and trust in reserve currencies becomes more fragmented. And while central banks do not typically buy large quantities of silver, their gold accumulation signals a broader theme of de-dollarization and diversification away from fiat systems perceived as vulnerable to excessive debt expansion. And speaking of debt, the fiscal trajectory of the United States adds another layer of structural concern, because multi-trillion-dollar annual deficits combined with a national debt approaching levels that strain long-term sustainability require continuous issuance of treasury securities, which in turn depend on investor appetite and manageable interest costs. Yet as interest payments consume a larger portion of the federal budget, the pressure to maintain accommodative monetary conditions intensifies, and historically prolonged debt cycles often culminate in currency debasement, financial repression, or inflationary adjustments that reduce the real burden of liabilities at the expense of purchasing power. And throughout history, precious metals have functioned as hedges against precisely those outcomes because they cannot be printed, digitally expanded, or politically decreed into existence. And this enduring characteristic underpins their appeal during periods of monetary uncertainty. And when you combine fiscal strain, monetary policy crossroads, industrial consumption growth, constrained mine supply, elevated paper leverage ratios, and accelerating physical delivery demands, you arrive at a convergence of variables rarely aligned so simultaneously. And skeptics correctly point out that exchanges possess mechanisms such as cash settlement options, rule adjustments, and emergency measures to prevent a formal default scenario. But even if a technical default is avoided, the psychological impact of forced cash settlements or sudden rule changes could undermine confidence in price discovery itself, potentially widening the gap between spot quotations and real-world premiums charged by dealers for physical coins and bars, a divergence already observable during periods of heightened demand, when retail buyers discover that the price on their screen does not match the price required to secure actual inventory. And this divergence represents the market's way of signaling stress beneath the surface. And while substitution in thrifting and industrial applications may occur over longer time horizons, if prices remain elevated, such adjustments require engineering redesigns, capital expenditures, and technological transitions that unfold gradually rather than instantly, meaning near-term supply tightness cannot be quickly alleviated through innovation alone. And therefore the price becomes the balancing force, rising until marginal demand hesitates or new supply emerges. And within this environment, the gold-to-silver ratio serves as an additional lens through which to evaluate relative valuation, because historically, during intense monetary crises, the ratio has compressed dramatically as silver outperforms gold due to its smaller market size and higher beta to capital flows. And if gold remains firm while the ratio narrows toward historical crisis levels, the implied silver price projections extend significantly above current levels, illustrating the asymmetric upside potential embedded within ratio normalization scenarios. And although no forecast is guaranteed and volatility can be severe in both directions, the structural ingredients for sustained strength appear aligned in ways that demand attention from anyone concerned with portfolio resilience. And prudent diversification does not require abandoning equities or liquidating productive assets, but rather incorporating exposure to hard assets capable of performing under conditions that challenge conventional financial instruments. Because tail risks, though infrequent, carry outsized consequences when they materialize, and preparation before consensus shifts is typically less costly than reaction after narratives change. And as more investors analyze delivery data, monitor inventory fluctuations, track macroeconomic signals, and observe premium spreads, the collective awareness of potential imbalance increases, potentially accelerating participation. And markets often move most aggressively when perception transitions from complacency to urgency. And silver's relatively small market capitalization compared to other asset classes means incremental capital inflows can have disproportionate price impact, amplifying momentum once established. And whether this unfolds gradually through steady appreciation or rapidly through a squeeze-like repricing will depend on the interaction between physical demand, monetary policy evolution, industrial consumption patterns, and investor psychology. But the confluence of factors currently visible suggests that dismissing the situation as ordinary fluctuation risks, overlooking deeper structural shifts taking place beneath the surface of daily price charts. And ultimately, each individual must evaluate data, assess risk tolerance, and determine appropriate allocation strategies based on personal financial objectives. Yet ignoring publicly available evidence of tightening inventories, elevated leverage ratios, macroeconomic fragility, and expanding industrial usage would mean forfeiting the opportunity to make informed decisions in advance of potential market transformation, because history consistently demonstrates that significant revaluations in monetary metals occur when confidence, liquidity, and physical constraints intersect, and those intersections rarely provide extended warning once momentum accelerates, making awareness and preparation critical components of strategic positioning in a financial landscape increasingly defined by uncertainty, leverage, and structural imbalances. This is Noble Metals. Thank you for watching. Hit that subscribe button if you have not already. Turn on the notification bell so you do not miss the next update. And I will see you in the next video. Stay informed, stay prepared, and I will talk to you